4 p.m. Eastern just printed, and after all the intraday swings, U.S. stocks closed slightly green on the first full cash session after the President's Day break.
The key is what happened underneath the index close. This was not a calm trend day. It was an AI repricing day with sharp rotation, then a late stabilization.
Quick session check first. Today is Tuesday, February 17th, and U.S. cash equities were open after Monday's holiday closure.
So we're in a holiday-shortened week, and that matters because thinner rhythm can amplify headline reaction and sector dispersion.
By the close, the Dow gained 0.07% to 49,533.19.
The S&P 500 added 0.1% to 6,843.22.
And the Nasdaq Composite finished up 0.14% at 22,578.38.
Those numbers look quiet, but the path was not quiet at all.
Exactly. The S&P tech sector was down as much as 1.5% intraday before recovering to close up 0.5%.
At the same time, software remained heavy. The S&P software index still closed down 1.6%, and names like Intuit and Cadence were down more than 5%.
That split is the main signal today: hardware-linked AI confidence versus software monetization anxiety.
And that's why just reading Nasdaq up misses the real message.
Let's add one public voice from the floor. Tim Grisky said, quote, "There's a lot of different trends going on. You see spikes up and spikes down."
He also said there will be a return to AI plays being very much in favor, which tells you pros are not abandoning AI, they're repricing where profits show up first.
Now development 2. Financials helped stabilize the tape.
Right. Banks including Goldman and JP Morgan helped pull the Dow from an earlier decline into a modest gain.
Development 3. Defensives and staples told a different story.
Consumer staples were the weakest S&P sector, down 1.5%, with General Mills down about 7% after cutting annual outlook.
Development 4. Single-name event shocks were huge.
Massimo surged 34.2% after Danaher announced a $9.9 billion acquisition.
Norwegian Cruise jumped 12.1% after Elliott disclosed a stake above 10%.
And Fiserv gained 6.9% on reports that Jana Partners built a position.
So again, this wasn't a broad beta day. This was an event and balance sheet day.
Exactly. If your process is still macro headline equals index direction, you probably got chopped today.
Development 5. Policy expectations are now sharing the stage with AI execution risk.
Reuters cited roughly a 63% probability of at least one 25 basis point cut by June.
But Fed messaging stayed mixed. Goolsbee sounded open to several more cuts if inflation resumes progress.
Barr emphasized patience, and Daly said the Fed needs a deeper read on whether AI productivity can rise without reigniting inflation.
That Daly point is big because AI is no longer just an earnings call buzzword. It's entering macro policy conversations.
Development 6. Adjacent global AI pressure is rising.
Alibaba launched Qwen 3.5 with agentic task framing, and that reinforces cross-border model competition right when U.S. software multiples are under stress.
Translation: the market is pricing not just AI demand growth, but AI pricing power risk.
Let's summarize today in one line. Indices closed green, but conviction stayed selective.
And selective conviction is exactly how medium-term dispersion regimes start.
Practical takeaway 1. In this tape, monitor subsector internals before you trust index headlines.
Practical takeaway 2. Separate AI adoption is real from this specific company captures margin.
Practical takeaway 3. Holiday shortened weeks can exaggerate intraday swings, so close-to-close calm can hide dangerous path dependency.
Also keep an eye on breadth. Reuters noted uneven advancing versus declining patterns across NYSE and Nasdaq, which fits a still fragile participation backdrop.
Before we close, one hot asset forecast.
Hot asset today is NVIDIA, ticker NVIDIA.
Base case. NVIDIA can keep relative leadership if enterprise and hyperscaler AI capex remains front-loaded into compute and networking through the next guidance cycle.
Catalyst 1. Continued evidence of resilient AI infrastructure orders despite software multiple compression.
Catalyst 2. Any confirmation from peers that inference demand is broadening, not just training concentration.
Catalyst 3. If rates drift lower while growth holds, high-quality AI cash flow names can keep attracting incremental flows.
Invalidation 1. Signs that enterprise AI spending is being delayed rather than expanded.
Invalidation 2. Policy or geopolitical shocks that disrupt advanced chip supply chain visibility.
Invalidation 3. If broad software weakness starts dragging hardware sentiment into a full de-risk cycle.
Final frame. Today was not risk on versus risk off. It was credibility on versus uncertainty off.
We'll keep tracking this market by timing, consequence, and where profits are actually landing.
For education only, not investment advice.